Okay, come to order. This is the Retired Employees Healthcare Benefits Trust quarterly meeting here at Bloomfield Township Hall. It's Wednesday, May 7th, 7:30 a.m. Let's begin with the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you again. Good morning. I'm Treasurer Michael Shostak. And with me today is Finance Director Jason Tice and Township Trustee Chris Kolinsky. And we are the trustees on the Retired Employees Healthcare Benefits Trust. We'll begin with public comment. Members of the audience who wish to address the trust may do so for 3 minutes. I'll open public comment. Seeing no public comment, we will move on. The next item on the agenda is to approve the minutes of the February 5th, 2025 Joint Board of Trustees, Financial Sustainability Committee, and Retired Employee Healthcare Benefits Trust meeting. Those minutes were in your packet. Were there any changes? Then I'd look for a motion to approve.
So moved.
Motion by Chris Kolinsky.
Second.
Support by Jason Tice. All those in favor say aye.
Aye.
Opposed? Okay, those pass. We move on now to our quarterly portfolio review, and we have with us from Mariner Institutional our advisors to address the committee on the quarter's results. We've got Brian Green and Mike Holycross. Morning, Brian.
Thank you.
And I'll note for the record, we are joined by Supervisor Mike McCready.
Thank you for letting me join you.
So what I've provided to each of you as part of the packet, so there's the traditional first quarter performance report. As we've had these conversations in April and May, it's always been interesting to me, the focus on recent results, obviously the purpose of this conversation, but the intensity of the reaction to the results is 100% dependent on whether you are a township, a county, a city, or some other underlying governmental entity, and what it really comes down to is when's your fiscal year end. Right, for the counties with the September 30 or 12/31 fiscal year end, they're like, whatever, it's the first quarter, we got 9 more months. For a lot of the cities with the June 30 fiscal year end, they're like, okay, we're 9 months in, but we've got May and April, May, and June to recover and see what happens. But in the case of Bloomfield Township, March 31st is year end. So while we may think of it as the start of spring or the start of golf season as individuals, or the start of allergy season in my house, based on my wife's reaction this morning. Either that or she was really displeased with me, but I'm going to say allergies. This is fiscal year end. So, as we look at what went on in the first quarter, a couple things. Look, this is one of those situations where diversification worked. Unlike calendar year 22, when the S&P was down 20% and fixed income was down 20%, and publicly traded real estate was down 30% or more, and international equities were down 20%. As we look at the first quarter of 2025, the S&P was down 4 and change. Small cap stocks were down 9.5%. So domestic equity markets with a tariffs on, tariffs off, tariffs on, tariffs off, tariffs on, but less tariffs. No tariffs on this product, but tariffs on that product, like that degree of uncertainty from kind of a trade and economic policy standpoint put U.S. equity markets in a negative territory, small cap stocks being impacted the most, but international markets, whether you're talking about developed markets as an example, so think Europe, Australia, Japan, were up almost 7% for the quarter. Emerging markets were up almost 3% for the quarter, and U.S. high quality fixed income was up between 2.5% and 3%. So unlike last year, where investors were not so much frustrated, but kind of looked and said, hey, everything I look at, I wish I would have had less international equity and more U.S. I wish I would have had less fixed income and more U.S. equity. The first quarter of 2025 was a stark reminder of why we have a diversified portfolio, because when what's been working pretty consistently, other than calendar year 22 as a minor hiccup, diversification finally worked. So this is one of those instances where we come in and talk about losing less money than the market and trying to spin that into a positive picture. So as you look forward, a couple things. Page 3 provides a historical breakdown of the trust. But we've added, and we're going to expand on this, page 4. Because you recall in April of 24, so after we closed fiscal year end for March, from really an expense standpoint and just an investment opportunity standpoint, the 5 retiree healthcare trusts from an investment standpoint were consolidated into one investment pool. Those 5 trusts are still tracked and accounted for independently. So as contributions go in, right, they're allocated where they need to be. And as investment earnings or losses are experienced, they're allocated on a proportionate basis. So that's what you'll see, for example, on page 4, we provide that breakdown of the term is unitization, but essentially provide a breakdown of the individual trusts, individual participating trusts. So if you want to look and say, hey, where is public safety at? Well, public safety was at just over $10.7 million as of the end of the quarter, and the cable portfolio or cable portion of the retiree healthcare trust was just over $1.9 million. So I always make this statement when we add something new to a performance report. There's definitely pride of authorship, pride of ownership. That being said, I've had trustees that I've worked with for 20 years that have finally said, like, hey, I'm colorblind and I can't read that report. I'm like, I've been sitting across the table from you for 20 years and I didn't know that. Like, we have a colorblind version of the market commentary that uses like different shading and grading rather than different colors. Like, this is for your use and your benefit. So if seeing this in a different way, look, I don't need squiggly lines, just give me dollar figures. Like, this can be adapted, and it can be adapted now, 6 months from now, 6 years from now, 6 days from now. So as you process this and work through it, please know, look, this is a chart created in Excel, and it's infinitely changeable to a fault. The next time Microsoft updates, it will probably change, even though that's not something that I wanted it to do. But let's talk about overall results. Page 5. So as I mentioned, this is one of those situations where we walk in and say, equity markets were in negative territory. But we had a few strategies that lost less, right? Outperformed in a negative market. It's always a tough victory lap. But, strategies that we would have expected to outperform actually did. So overall, the combined portfolio was down 2.2% for the quarter. Versus the policy index that was down 177 for that same time period. And then whether you want to look at the fiscal year-to-date column or the one-year column, they're going to be measuring that same time period. So for the fiscal year, the retiree healthcare portfolio was up 3.4% versus the policy index that was up 4.7. So if we talk about the quarter, what helped and what hurt, honestly, the only portfolio that hurt from a relative performance standpoint, meaning performance versus benchmark, forget about positive versus negative, just what caused that lag was Ancora. And what's interesting about the Ancora portfolio is, of the 2.3, almost 2.4%, sorry, of the 4.3, almost 4.4% of underperformance, 2.4 of that 4.4, so a little over half of the underperformance came from one name, Broadcom. Tariffs, right? And uncertainty around trade and and what's going to happen there. The others were names like Apple and Microsoft. So, as they looked from a dividend focus and a value focus, as some of those names traded off, they were in the portfolio. What had been leaders for them for years in the first quarter have been laggards. Well, some of those names have recovered pretty significantly here in April, and particularly absent yesterday, best 9-day run in the S&P 500 since 2004. So you've seen a decent recovery there. The piece that's not necessarily here, but is kind of embedded in is, we eliminated Edgewood early in the quarter and consolidated those assets into the S&P 500. Well, large cap growth stocks in the first quarter were down almost 10% versus the S&P down 4 and change. So that shift was beneficial. That isn't something that you can see in any individual line, but just that reallocation and kind of further diversifying some of the exposure helped. So no surprises out of Fidelity with the S&P 500 index down 4.3, right in line. Clarkston outperformed for the quarter, down 6 versus benchmark down 7.5. So I will tell you, coming into the quarter, they had about an 11% cash balance, so that helped them in the first quarter. If you look at the March 31st statement, for example, for the DB portfolio, because that's a separately managed account, they closed the quarter at 11% and fixed it at 11% in cash. Today they're at 5. So in April and early May, they put about half the cash to work, added one new name to the portfolio called MedPace. It's a publicly traded, they're based in Cincinnati, a publicly traded kind of outsourced clinical trial bioscience company. So that was 1% position that they added to the portfolio. The other, the term we use is window dressed, which I realize may have negative connotations, but it's just the way that it's always been portrayed. But they essentially allocated cash across existing positions in the portfolio. So added to the other existing kind of 20 to 22 positions. Clarkson's always been kind of stodgy and stubborn about if stocks don't meet if we think the stock is worth 100 and it's not at 70 or less, we're not putting cash to work. And if a stock that we bought at 70 hits 100 and we don't think it can rally from there, we're out and we're going to hold it in cash. So they've been very, very strict with their investment discipline. So we view it as a vote of confidence from the portfolio management staff in the existing positions to say, hey, some of these names have traded off a little bit. We're going to add to them. And it's not just adding to one or two names, but adding to a broad swath of names across the portfolio. So one new name added, as I'd mentioned, and the remainder of about half that cash put to work. So they're now down to 5%, which in the active management community is kind of the upper threshold of being treated as or viewed as fully invested. So good signs there. Reinhardt, new addition to the portfolio back in May of last year, outperformed for the quarter, not because of cash, just because of individual names in the portfolio. You see down 5.7 versus benchmark down 7.5. Fidelity Extended Market, no surprise, right in line with their index. Recall that is the entire U.S. equity market minus the S&P 500. So it is generally considered a proxy for small and mid-cap stocks, but you can have large cap names. Tesla in 22 before it was added to the S&P 500 would have been the largest name in this index. Blackstone's in there, BlackRock. There's a few other large cap names that just haven't been brought into the S&P 500 that exist here. The biggest driver of performance would be the Fidelity International Index Fund. You see up 8% for the quarter versus its benchmark up 6.9. You may say, hey, wait a second, you just said index fund, and I see 1.1% in outperformance. So one of the stumbling blocks or one of the issues you face with replicating international equity markets, right? The S&P 500 you can go out and do in an individual portfolio, just because of the liquidity and transparency and the number of shares available to trade on a daily basis. You can even do it with the Russell 2000 index just because of the amount of, the term is float, like the number of shares available to trade. From an international standpoint, because of the amount of money in the index fund portfolio, they can't buy every single name that's in the index. So they say, look, if financials are 20%, we're going to be at 20%. If insurance as a industry, as a part of the financial services sector, if insurance is 10%, we're going to be at 10%. If property and casualty is 5% of that 10%, we're going to have 5%. But if there are some smaller names that they can't own because they would have a controlling interest, or there just aren't enough shares available, they use what's called a replication approach. So over time, it's going to resemble the index, but you're gonna have periods of outperformance and underperformance when some of those names at the margin are lagging or outperforming. From a fixed income standpoint, Baird right in line, up 2.4 versus their benchmark up 2.4, so no surprises there. And the new additions to the portfolio, neither have priced yet for the first quarter, just given timing. Bloomfield would probably be within the next week. But if you look over in the far right-hand column, the majority of the money is in Series C. It's put to work in November of 2024. Recall that is loans backed by private real estate. Typically 50 to 60% loan to value on a property that needs some work that is in a period of change. So 2 to 3 year bridge loan. That loan to value is based on Bloomfield's calculation, not on the purchaser's calculation, so it's even more conservative. So positive returns out of the gate for them on a broad basis. And then the private equity portfolio with Capital Dynamics, the negative return you see there. Once we don't yet have 12/31 pricing, just because of the timing, right? That is a portfolio comprised of a number of underlying private equity funds. And December 31st is always longer for pricing because all of those underlying funds are going through their audits. So those funds need to prepare their audited financials that they then provide to Capital Dynamics for them to do their audited financials. So usually like mid-May, we get 12/31 pricing. Late May, we get 3/31 pricing. Expect that number when it does come in to be positive and to be something that you're happy with. That initial negative return you see is just a result of interest that we, as a later entrant into the fund, had to pay to earlier investors. But with the write-ups that we've already seen in that portfolio, I'd expect that number to be something where you look at me and say, is that right? And the answer is yes, when it finally updates. So all in all, that despite negative equity markets, the portfolio held in kind of where expected. We saw outperformance where we expected to out of the more conservative managers like Clarkston and like Reinhardt in the small cap space. I would say the one disappointment was Ancora, but I can't be disappointed with names that have been long-term, right? These are great long-term companies that have driven, 5-year number is ahead, since inception is ahead because of names like Broadcom in the portfolio. So, 1 quarter with concern over tariffs and what impact that has on their business line, I'd say that's a miss that can be forgiven, particularly the recovery we've seen here in April and May. Questions?
Questions from the committee?
No.
Okay, thank you, Brian. We will also review these results as part of the Financial Sustainability Committee coming up. That looks at both the pension and the retiree health care. This, of course, is just the retiree health care. The next item on the agenda is the custodial banking services RFP. So as we discussed at our last quarterly meeting, I issued an RFP for custodial banking services. I wanted to make sure we were getting the best possible pricing, the best possible service. I'd say our current custodian has left some services to be desired, both technologically and in just service performance. So I handed out to you the results of the RFP. We received 4 responses: Fifth Third, Comerica Bank, US Bank, and PNC Bank. You see the analysis there in terms of how many different plans they manage for, the number of assets. These are all, major regional banks. Of course, the JP Morgans and the Bank of Americas were just way too small for them. But these are the regional banks that we got to respond to us. And the lowest cost to us, we calculated as US Bank. Now remember that this is to consolidate our custodian banking services for 3 different trusts. The first is this trust, the Retired Employees Healthcare Benefits Trust. The second is the Defined Benefit Pension Plan Trust. And the third is our operating reserves, which we currently hold at two different broker-dealers. I wanted to consolidate that so that we could also bring in potentially an investment manager for that portfolio. So we're going to consolidate all of the custodial services. U.S. Bank came in at the lowest cost. Brian and I had conversations with both U.S. Bank and PNC Bank. We took a test drive, a demo of their online platform for the services for monitoring the assets as well as entering orders, moving money, all that kind of stuff. In the end, while they are both very good, I think that I like U.S. Bank's platform a little bit better, and as it turns out, we got them to waive, they were originally going to charge a trade fee. We got them to waive that, so that brought their cost down to be the lowest cost. So they're going to charge 1.5 basis points on market value of assets, and $100 a month for limited partnership interests that we hold. So, we hold Bloomfield Capital, we hold Capital Dynamics, we hold ABS in the pension plan. Those will be just a flat $100 a month. Otherwise, on all of our other funds, it'll be 1.5 basis points annually. So we estimate, based on our current portfolio, that it's going to be about $32,000 a year across all of the trusts. And as I said, that is the lowest cost here in the responses. So any questions from the board? Okay. Then we don't need to vote or anything since we're just an advisory committee, but I would just like consensus to move forward with U.S. Bank, transfer the assets. Their reporting is also much nicer, Jason, and you'll like their online system. It's easier to use than our current platform. So, questions, comments?
So you said you test drove U.S. Bank and PNC?
Yes.
Why not Fifth Third? Because they are
Fifth Third's our current provider,
Okay, so
we
you already
are familiar with them.
Okay. So, no, again, going with the lowest qualified bidder sounds like a great idea to me.
Yeah.
Michael, one comment.
Yeah, sure.
It flies below the surface, but from a security aspect, the change here, Fifth Third, if we have a capital call, I send a letter to Michael in Word via email, and he signs it, scans it, emails that letter with account number, wiring instructions, routing number, his signature, all of that aspect. That's out, across the web, right? Here, we log in, Michael, we need to make a capital call for Capital Dynamics. Michael logs into a secure portal on the U.S. Bank website, enters the wire, and it only resides there. So there's no letters being transferred back and forth. Everything's done through a secure portal. Or if we need to move funds between accounts, there isn't a letter being sent that has our account numbers out there, that could potentially be a security exposure. It's all embedded within the bank's secure website. So it's an intangible benefit, but I think very, very significant. We're not only saving a little bit of money on an annual basis, but we're dramatically reducing risks to the organization. And to me, that's an invaluable benefit. You can't quantify the dollar value of that to eliminate that risk or reduce that.
100%. And also, our current process, as Brian pointed out, is very manual, very, human-centric. So I have to sign a letter authorizing a wire transfer, goes to an email address that's monitored by several people, a team, and then they have to go in and they have to enter. So there's too much human keying of information. We had issues, like I said, with service from Fifth Third. A wire transfer got missed that I had sent in and it didn't get sent, and Plus they've had some reporting issues, they paid bills out of the wrong accounts, and so like, there's too much, it's too, the fact that they, have so much capital under management that they're, or custody, and how manual and not automated they are is just baffling to me. That was really the impetus for running this process. And so I'm pleased that we got several bids. Comerica was just way too expensive, just not even in the realm of close. But US Bank and PNC, have great platforms, decently priced. US Bank turned out to be the lowest, which is great, by a few $100, but anyway, so that's the, and Brian's firm has experience working with them. We know that they're good at what they do.
Quality institution.
Yeah,
That's great.
so. Okay, so if there's no more questions, I'll assume that we have consensus on moving forward with that. We have no other new investments to look at this time. And we are right at the end of our time slot. So unless there's any other new items, I'd look for a motion to adjourn.
So moved.
Second.
All right, all those in favor?
Aye.
Opposed? Okay, that passes. We're adjourned.